Silver just did something it has only done twice before in the last 50 years, and if you are not watching this chart right now, you are going to miss the setup of a lifetime. In the next 30 minutes, I'm going to walk you through exactly what triggered this breakout, why it rhymes with two of the most legendary silver moves in history, why smart money positioned for this month before the headlines caught up, what the real risks are that most channels won't tell you about, and where this realistically goes from here. I'm not here to hype you up with vague promises or empty predictions. I'm going to show you the actual chart, the actual price action, the actual forecasts from real institutions, and let you draw your own conclusions. So stick with me all the way through, because the final section of this video is where the actual strategy conversation happens, and that's the part most people skip straight to without understanding the setup first, which is exactly how people get burned in this market. Let's start with where we actually are, because the raw numbers here are almost hard to believe. Silver surged 147% in 2025, one of the strongest years for the metal on record, and it went on to hit a nominal all-time high of 121.64. And think about that for a second. That is not a slow, boring grind higher that nobody notices. That is a parabolic move that caught almost the entire retail investing world completely flat-footed. Silver broke through its previous all-time high back in October of 2025, blasting straight through the $50 mark that had capped it for decades. And then it kept rallying to new highs again and again until it finally overtook the $100 level just a few weeks into 2026. From there, it kept climbing until it set its most recent all-time high of 121.62 on January 29th. And here's the number that really puts this in perspective. As of early March 2026, silver was up over 189% year over year. Not 18%, not 89%, 189% in 12 months. That's silver nearly tripling in a single year, and it happened while most of the financial media was still debating whether gold was too expensive to buy. Now, after a move that violent, you would expect a sharp pullback, and that's exactly what happened. Silver touched that all-time high near 121.62 before a brutal, margin hike-driven correction out of the CME sent it tumbling all the way back down towards 70 DILA. That's the kind of drawdown that shakes weak hands out of a market completely. If you were holding leveraged silver positions during that stretch, you know exactly how violent that felt. But here's the part that separates people who actually understand market structure from people who panic, sell at the worst possible moment. After that shakeout, silver didn't die. It didn't roll over and fade back to where it started. It consolidated in a high-range, high-volatility band, typically trading somewhere between $80 and $90 an ounce in the months that followed. That is not a collapse. That is a market digesting an enormous move and building a new base before making its next real decision. And by mid-March, silver was already testing $9 an ounce for a third consecutive gaining session. By May, we saw silver post its biggest single-day jump in months, rising more than 7% at its peak, trading around 86.60 in that window before cooling off again. If you zoom out and look at the shape of this entire move, parabolic spike, sharp correction to shake out leverage, multi-month consolidation range, renewed push higher on strong volume, that is a textbook technical structure. And if you've followed the metals market long enough, you know this pattern doesn't come around often. It's worth actually going back and looking at the history here, because this is where it gets interesting. Silver first attempted to break $50 back in January of 1980, during the infamous Hunt Brothers episode, when two wealthy Texas brothers tried to corner the entire physical silver market. Silver hit $48 that month, and then it reversed the very next month and collapsed all the way back down to $11 by May. It stayed essentially dead for the next 20 years. Then, in April of 2011, silver made its second serious run at $50, driven by the post-financial crisis flight into hard assets and quantitative easing fears. And just like 1980, it reversed the following month and was back down near $30 by September. Two attempts at $50, two brutal reversals, decades apart. That's the history every serious silver trader has had burned into their memory. But look at what's different this time. Silver made its first ever sustained break above $50 back in October of 2025, and it pulled back to $47 in November, which looked at first like it might be the same old pattern playing out a third time. Except this time there was no full reversal. Instead, price pushed on to set the current all-time high in January of 2026. That means we are now many consecutive months into $50+ silver, which has never happened before in the modern history of this market. Not in 1980, not in 2011. This is genuinely unprecedented territory, and that's exactly why so many analysts who have covered this market for decades are treating this breakout differently than the last two. So let's talk about why this is happening, because the why matters more than the price action itself, and this is where I think most coverage of silver completely misses the real story. This isn't just retail speculation running wild the way it was with the Hunt brothers in 1980. Silver's central role in chip manufacturing and battery production, combined with its recent recognition by the U.S. Department of the Interior as a critical mineral, has become a major factor sustaining this momentum. This is not the silver market of the 1980s, driven by one family trying to squeeze supply for profit. This is a silver market caught between old world monetary demand, the kind driven by inflation fears and currency debasement worries, and brand new industrial demand from solar panels, electric vehicles, and especially the explosion in AI infrastructure and data center build-out, all happening at the exact same time. That combination, old world hedge demand plus new world industrial demand colliding in the same market at the same moment, is genuinely rare, and it's a big part of why this breakout has held in a way the previous two didn't. On top of that, you've got the fund flow story. Strategist Claudia Will at J. Safra Saracen pointed out that ETF flow price sensitivity has been measured at over 13% since October of 2025, and that single factor explains roughly 2/3 of the massive price increase in silver since the start of that month. In plain English, this means institutional and fund money, not just individual investors buying coins at their local dealer, has been a huge driver of this move. When you see a market being pushed by large, structured fund flows rather than just retail excitement, that tends to be a more durable kind of demand because institutions aren't buying a few coins on a whim, they're making meaningful allocation decisions. And then there's the structural story underneath all of it, the one mainstream financial media almost completely ignores, and honestly the one I think matters most. There is a growing divergence between Eastern and Western silver pricing, with silver trading near $87 in Shanghai while the Western COMEX price has lagged behind. That gap is being driven by physical demand cracking the paper futures market. One analyst described it in a way that stuck with me. The entire paper pricing system for silver has functioned for decades on one simple, unspoken assumption that nobody would ever try to take physical delivery all at once. In early 2026, that assumption failed. That's not a conspiracy theory, that's a plain description of a market where the paper contracts trading on the exchange are starting to disconnect from the physical metal that people, funds, and even some central banks actually want to hold in their hands. When that disconnect widens instead of closing, it tends to resolve in one direction, and historically that direction has not been down. Now let's talk numbers, because I want to give you real forecasts, not just vague hype, and I want to show you just how wide the range of professional opinion actually is right now, because that in itself tells you something important. On the conservative end, institutional forecasts from JP Morgan and the LBMA consensus average around $79 to $81 an ounce for 2026. TD Securities sits a bit above that, with an average annual price target of $65.50, but a full-year high estimate of $118, which tells you even the more cautious desks are pricing in serious volatility. On the far more aggressive end, you have real institutional names attaching real numbers to scenarios that sound almost unbelievable if you say them out loud. Major banks including Goldman Sachs, JP Morgan, and Bank of America have forecast gold reaching somewhere between $4,900 and $5,300 by late 2026, and the silver predictions floating around have been even more dramatic, with individual targets ranging anywhere from $100 to as high as $375 an ounce from various analysts. On the extreme bull end, one scenario built around the gold to silver ratio compressing down into the 40 to 50 range, which would be the low end of its 30-year historical range, suggests silver prices near $160 by the fourth quarter of 2026 and potentially as high as $220 the following year if that compression continues. I want to be completely honest with you here, because this is exactly where a lot of channels lose credibility with their audience, and I refuse to do that to you. Nobody, and I mean nobody, knows the exact number silver is going to hit. Anyone who tells you with absolute certainty that silver is guaranteed to reach some specific price by some specific date is selling you something, not analyzing a market. What I can tell you, based on the actual structure of this move, is that the combination of industrial demand growing at the same time as monetary demand, real supply tightness showing up in the physical delivery data, the widening gap between Eastern and Western pricing, and a technical base being built in that $80 to $90 range after a historic all-time high, together represents the kind of setup that has historically preceded major continuation moves far more often than it has preceded outright collapses. That does not mean there is no risk here. It means the structure favors continuation, not that continuation is guaranteed. And I do want to spend a minute on the actual risks, because a responsible breakdown of this market has to include them. Silver is one of the most volatile assets that exists, more volatile than gold, more volatile than most equities, and it has proven that this year in both directions. A margin hike from an exchange, a sudden strengthening of the dollar, a shift in Federal Reserve policy, or a broader risk-off event in equity markets can hit silver hard and fast, exactly the way that CME-driven correction knocked it from its January high all the way back towards $70 in a matter of weeks. Industrial demand, while a genuine structural tailwind right now, is also tied to the broader economic cycle. If we see a real slowdown in electronics, solar, or EV manufacturing, some of that industrial demand story weakens. And the wide dispersion in analyst forecasts I just walked you through, from $80 on the low end to well over $200 on the high end, is itself a signal of genuine uncertainty among professionals who study this market for a living. If the smartest people covering silver can't agree within a range of $150, you should treat any single number, including the exciting ones, with appropriate skepticism. So here's what I would actually be watching if I were tracking this market closely myself, and this is the part I want you to really pay attention to, because this is where the analysis turns into something usable. First, watch the $90 to $95 zone. That range acted as the launching pad for silver's push toward its all-time high earlier this year, and if silver can close above it on strong volume and hold there across multiple sessions, that's typically a signal the consolidation phase is ending and a new leg is beginning, rather than just another failed attempt like 1980 or 2011. Second, watch the gold to silver ratio closely. When that ratio compresses, meaning silver strengthens relative to gold, that has historically signaled we're entering the more speculative, momentum-driven phase of a precious metals cycle, the phase where silver has tended to significantly outperform gold on a percentage basis. Third, and this is the one most retail investors never check, watch the COMEX delivery notices and the physical premium data. Along with that Eastern-Western pricing gap, if that Shanghai to COMEX divergence continues widening instead of closing, that tells you the paper market is still under real structural pressure from physical buyers, and that historically has been one of the more reliable tells in this market. Now, I know a lot of you watching this are asking yourselves, is it too late? Did I already miss it? I get that question constantly, and I want to give you an honest answer instead of a sales pitch. Nobody who bought silver back at $50 in late 2025 felt like they were on time either, because the metal had already run hard just to get there. That's the uncomfortable truth about genuine